Hi, good morning. Welcome. Happy Wednesday. I'm Dennis Morton and here with Katie Brown. Katie, how are you?
I'm doing well. Thank you, Dennis. How are you?
Good, good. We're co-founders and principals of Morton Brown Family Wealth, and we're trying something new this morning. With all the market volatility this week and the questions we've been receiving from our clients in our community recently, we wanted to jump on live this morning and start doing these sessions to answer some questions that we've heard in recent weeks about what's happening in the markets and financial planning, and also field live questions from you. So we have a live audience today. So we're going to talk about some questions we've received in advance, but please feel free to enter in some of your specific questions in the chat. We want this to be interactive, and we'll answer those in real time. So it'll be a short session this morning, but we just want to cover some things that might be top of mind for you. So it's your time. Feel free to write in questions in the chat, but we'll kick it off right away. So Katie, we were looking at a few articles here in the last couple of days, trying to put just the circumstances among all asset classes into context. So Jeff Kleintop, investment strategist at Schwab, had a piece where he talked about the three bears, and those three bears being the bear market in stocks, the bear market in bonds, and the bear market in cash. What were some things that you took away from his piece about just the nature, the uniqueness of that phenomenon that's happening right now?
Right. Well, I think that's the first thing, is just how rare it is to have an environment where those three things can converge. When he was looking at the history going back to 1950, so 70 plus years, I think that's only occurred, was it two times? They were both in the 1970s?
Both in the 70s, yeah.
Exactly. So, and just to kind of touch on what those three bears, kind of what constitutes a recession in those areas. We're used to talking about stocks, and typically there are a couple of different ways to define it, but one of the most common definitions is a 20% reduction or 20% drop in like the S&P 500 is when you start to hit those recessionary levels.
Mm-hmm.
And a couple of Fridays ago, we dipped down into that for just a little bit, and then we ended up closing just above. So we're kind of right on the fringe of that when it comes to stocks. Dennis, how about bonds and cash? If you want to kind of talk about what constitutes a bear market there, I think that would be helpful.
Yeah, so bonds, they're a little bit different. They respond to different things. So bonds typically go down in price when interest rates rise. So when we see a dramatic decline in bonds, in this case about 10% on the aggregate bond index, that's going to constitute roughly a bear market. Cash, on the other hand, cash isn't declining in value, it's declining in purchasing power. So when we see a big spike up in inflation, as we've seen, that's where cash enters its own bear market. Although, Katie, I was reading something last night. Howard Marks at Oak Tree Capital has his investor letters that he sends out quite frequently, and they were a great read, kind of a long form read. But his comment was he took umbrage with the definition of a bear market. He said, he read two different headlines, one from maybe the Financial Times that said stocks are down 20%, we are in a bear market, but they'd only kind of crossed the line and gone back. The same day, another publication said stocks finished at 19.8% down, we're out of a bear market. And he said, that's silly. The definition of a bear market is that things feel awful. That's it. So if it feels awful, you're in a bear market, and you should start thinking about what to do and how to be responsive for it. So I think what we note here for stocks, bonds, and cash, it feels awful right now. It's not a great feeling. So then what do you do about that? So how does he talk about the kind of how things come back? Because the cash bear market, those are typically pretty short. When he talks about that gap between cash and inflation, the yields on cash and inflation, the wider that gap gets, the closer they are to reverting. I think he said that the signs of inflation start to peak usually when you get to those wider gaps, right?
Exactly. And I think that's the fascinating thing, that kind of in all three of these areas at different times, that flip of that switch can happen pretty rapidly. And I love that story that you just said, we're in a bear market, we're out of a bear market, because when we look at different periods of time, sometimes that next bull market starts at the very bottom of the bear market.
Yes.
That turnaround time can be so quick. Sometimes it drags out longer, but there have been periods of time where 1998, where there was a recession, it dropped down, and then that same day the next bull market started.
Yes.
So it's kind of fascinating, that definition and that change, that transition. And that can happen also pretty quickly, like you said, in cash and in bonds. And I think that's something that's been fascinating. We started this year as like the worst year for bonds on record. And
Hmm.
but when we look at other periods of time um, when there have been, sell-offs in bonds, that recovery historically has almost been faster than some of the stock recovery. So
Yeah,
it's
yeah. And there's a silver lining. We have a question here about, and maybe this ties it in. What are our thoughts on cash in savings accounts? And that probably ties into the bond conversation, and also another article that we pulled up too.
Mhm.
Because if you've been sitting on cash, and maybe that sense of paralysis kicks in, like, what am I supposed to do if I have more cash than I really need, but the equity market doesn't feel great? What do I do with it? The
Mhm.
upside to the bond market being down is that yields are up. You can earn 2%, you can earn 3% where you could only earn 2 maybe a year ago, and even less than that. So you might not see it in your CDs and your savings accounts, but I think you can. And I'll just pull this forward now. There was an article in Morningstar, and we're going to send out some follow-up. We'll post with the recording of this some links to these articles. But Christine Benz over at Morningstar wrote an article, "The Best Places for Your Short-Term Investments," and she talks about what the things you should consider. And there are 3 things that she says we should be thinking about. One is, first, yield. How much can you earn on it? Because you don't want to, we'll get to that in a second. Yield, liquidity, and guarantees. So if you're sitting on cash, you want to think, all right, what kind of yield do I want to get? And what kind of quality do I have? So if if you reached out for a 5% or 6% yield a year ago, you probably got clobbered recently because you bought a long-term security or you bought something that was low quality and everything else. So you got to be careful about where you're getting your yield. But Katie, talk about liquidity. When we buy something like a short-term bond index or a short-term bond ETF, like you're getting a little bit of yield above cash, but you're still keeping your liquidity, right? I mean, it's not something, you're not locked in like you would be for a CD.
Yeah, that is important to balance that out and to really put the work into thinking through your cash. Like, what is the purpose of the cash? Do you need it, short term, midterm, longer term? When will that be needed? Because the liquidity factor is real. And you need to make sure that you're not reaching too far for that yield and giving up the liquidity in the meantime.
Mhm.
So I think that's really important to make sure that when you need those dollars in hand, you can get those dollars in hand. Um, and like you said, that goes back to the CDs. I mean, CD rates are on the rise, which is fantastic. So you can get a decent rate, which we haven't seen in years on 3-year, 5-year CDs. But if you need that money beforehand, then you may be giving up some of that interest. So really pay attention to the timing of when you need the cash and um, you know the period of time in which you're trying to grab that income.
We haven't talked about this much, I don't think, but there's that whole 6-month rule that keeps 6 months of living expenses and savings and cash
Right.
just readily accessible. We've had to accept that that's not going to earn much for quite a long time.
Mhm.
But then there's also kind of the sleep at night money, which is probably like 2 years worth of living expenses. Where you're like, if I really needed it, or if I didn't want to have to worry about the market, what do I have in safety? I think probably your 6-month money is still sitting in cash and probably not earning much, and you're checking your savings account. But if you're looking at the excess of that, the next 18 months, maybe you can start looking at short-term bonds, short-term ETF, and accepting that it could still be volatile. That there is downside potential in that, maybe 3 or 4%, maybe not the 10 that you're getting on an aggregate bond, but you're picking up a little bit of yield, and that trade-off might be okay. That's something that we're working through with clients right now because for good reason, household balance sheets are still in pretty good shape, and there is cash sitting on the sidelines.
Right. Well,
Good point.
that's and when I know, internally when we design our strategies too, we always want to make sure that we have a short-term component for that purpose also for
Mhm.
liquidity if something may be required outside of the cash reserves that, people typically have on hand, but then also so that if we do have periods of volatility and either we need something or if we could opportunistically take that and rebalance with it, then so I think there's there is a good reason to kind of have that almost intermediate cash or cash, money on hand,
Right.
uh, which may have a little bit more volatility, a little bit more risk to it, but you can grab it, more readily than something else that might be moving faster.
Yeah, and then to make the case for when Jeff Kleintop, you talked about kind of the how cash comes out of a bear market. It's usually when inflation peaks, and similarly bonds. Jeff Kleintop in his piece talks about that since 1980, every time we've had kind of a big run up in bond yields and a kind of beat down on the prices, there's been some deflationary event that kind of tamps that back down and brings everything back to normal. So you had the 1986 oil crash, the fall of the USSR, Japan bust in 1991, all the way up through the 2020 pandemic. There's something that causes inflation. There's a growth event, a negative growth event that causes things to tamp back down, and that kind of brings bonds back into favor. Maybe we've started to see that a little bit. You've started to see yields, kind of become a little bit more muted recently, and seen prices come up a little bit. So we'll see if that continues.
Hey, Dennis, just to tie back to that question again, though, as far as like cash and savings accounts, one of the things that Christine did point out in her article is start to look for like online savings accounts, because we're starting to see some increases, back in the yields that are offered in online savings accounts, kind of above and beyond what you might get inside of a money market or a cash sweep account or something else that still provides that liquidity, and that you don't get necessarily caught in a guaranteed trap. I think that's something to be careful about too, is kind of seeking guarantees. You can start to kind of get caught in those traps. So just to be careful with that. But there are some places that you can seek, and I bonds. I feel like we've had a lot of conversations around I bonds and people asking, can I actually get 9% on a government bond? So maybe we can spend just a couple minutes talking about some of the yields that are there, but also some of the restrictions with that.
Yeah, it's a good place if you're sitting on a few $1,000s and looking for a place to park it. I mean, the limit is $10,000 per individual. So you're it's a tactic, not a strategy, I guess is the best way to put it. And it's a place to park things. I think that's where it's a unique element of this environment, that things have been moving so fast that you really need to survey a broad landscape of asset classes. I think we continue to hear that over and over again. There's no one solution that works for this environment, because you can't solve for the inflation trade and the rapid growth trade from last year and all the other things happening. So you kind of have to be very strategic and broad, and I bonds can fit in there. So what would you say would be a good situation of using I bonds, Katie?
I think for some of that kind of intermediate cash, or if you do have, your to really get the yield out of it, you need to hold it for 5 years, and also recognize that interest rate resets every 6 months, I believe, and so it's not you're not locking in that 9.6%. I apologize if I'm saying that number wrong, but you're not locking that in for the entire period. So definitely recognize that. But if you have, I think that intermediate kind of, if you have your 6 months of cash on hand, or maybe you have 4 months of living expenses on hand, depending on where your other income streams are coming from, you might be able to lean a little lower on that sort of rule of thumb. So maybe there are pieces then that you start to kind of ladder or stagger in there, so that you have those maturities coming back to you.
Yeah, very good.
There are different ways you could use it.
We've had a couple more people join in. Just want to let you know we're answering some questions live here. If you have something that you're wondering about, you've observed in the market, and want us to offer our perspective, feel free to enter in questions into the chat. Another thing about, why don't we touch on, I know we're going to talk about just kind of the stories that surround investing, but real quick, while we're kind of mentioning inflation, there was a piece that came out yesterday. Liz Ann Saunders from Schwab had a piece where she was talking about just the dynamics that have maybe influenced inflation here in the last couple of years. And this is something you may have heard us talk about in previous sessions. The household savings rate and kind of the cash that's been pumped into the system through transfer payments, stimulus, all of those things here in the last couple of years due to the pandemic. And she had a really interesting observation, that the percentage of the personal savings rate as a percentage of disposable income had been steady at around 8% for a really long time, for the last decade or so, just kind of in a very narrow range. Once the initial stimulus went out in April of 2020, that savings rate went up to 30% plus. So multiplied many times over. And then you started to see, and what her observation was, that all went into goods. People bought stuff. That was where all the used cars were bought up, all the new cars were bought up, housing supplies, you name the goods, they were all bought up in that initial phase. Now we're kind of moving on to a second phase where the payments have kind of started moving over to services and away from goods. But her point is the savings rate right now, the personal savings rate, has come down from a peak of almost 35% a couple of years ago and is now down to 4.4%, which is as low as it was in 2008. So is there as much cash chasing after kind of the service side now that services are starting to ramp up a little bit? And is that an indication that maybe inflation starts to wane? Katie, that's what we've been kind of monitoring this for a while, is that how this was a consumer-driven economy pre-2020, still remains a consumer-driven economy, and how active is the consumer going to be?
Yeah. I think that it's fair to recognize too, around the time that the savings rate was spiking, everything shut down. So literally you couldn't spend money on a lot of the bigger travel item, different things that you might have spent money on, going
Right.
out to eat, a lot of those service oriented items. So where you could spend money was buying stuff online, buying stuff. And so I think that's where a lot of the stuff, the goods, the money pouring into the goods made a lot of sense because everybody was preparing their home for, all right, life at home, from work to exercise to entertainment to, just relaxing, everything else. And so I think people were kind of forced into almost goods consumption more so than service consumption. But I agree. And this is, if I'm being totally honest, this is one of my areas of concern, that consumers are starting to set new habits with spending. And so I do get concerned when I see those savings rates dropping down close to that 4%, or almost half of what it was kind of historically before. I mean, savings rates now are down around financial crisis levels, like the levels leading up to the financial crisis. And so I think there are a lot of things that are working for us in the economy, but I think that we could be our own worst enemy here, and I do have some concerns about the level of spending.
Yes. And then, kind of another question that we received in a couple of different forms was the questions take a shape something like this: what about this current phenomenon, and what are the long-term implications for that? And the challenges, like you talked about, with personal savings or inflation, oil prices, lumber prices, when the chart looks like this, it's really hard to
Straight up and
extrapolate
straight
that
down.
out.
Somebody didn't see that.
What's that?
Almost straight up and straight down. If for some reason that's
Yeah. If the chart looks like that, and that's what I'm looking at, that's the personal savings rate over the last 2 years. If the chart looks like that, you can't extrapolate that out over the long term. That is a short-term data point that has it's almost like a statistical anomaly. You can't you almost have to throw it out and say at some point we settle into a normal, but you can't project that out long term. Same thing goes for any investing strategy. And we'll get into that. So just be careful about taking short-term phenomena. But you're right. What if the spending patterns kind of settle into a routine and people kind of keep digging that hole as other things are happening? That could be a problem for the consumer balance sheet and a consumer-driven economy. So, Katie, another question that we get sometimes is, we'll call it a story-related question. What do you think about electronic vehicles? What do you think about cryptocurrency? What do you think about, I've heard this story, or the story's being told. What do you think about it? We found a really good article about, the cautionary tales about why we're so susceptible to stories, especially when it comes to investing. I think we both found this pretty fascinating. An important thing to remember as investors, right?
Mm-hmm. Yeah. There, exactly. So there was an article that just talked about, anytime there's a story around something, it triggers, in your mind, like it triggers emotions. You either want to be a part of it, you want to help save it, you want to be like, there's, the hero stories, like, yes, we can save the day with this. There's,
Hmm.
the Cinderella stories, the rags to riches, the different stories that really do kind of pull people in. And we see this across our entire spectrum of life in every area. This is not just a financial thing. Um, and they can be so powerful for good or bad. And I
Right.
and I think that we've seen some of the negative implications of some of the stories. If we think back to last summer, how many times did we hear people talk about, like, oh my gosh, I need to get in on this, like, this cryptocurrency. I need to get into this hot stock or something because all
Hmm.
these people are making all this money and it never goes down, and there's danger in getting caught, I think, in some of the stories.
Yeah, and the author in the article, he talks about the something that we all might have seen. I don't remember the Matt Damon commercial. I think it was a Super Bowl commercial. At least it was during the NFL playoffs. I know it started coming out. But in the Matt Damon commercial, it's a commercial for cryptocurrency, I think, a crypto exchange, and he's talking about fortune favors the bold, right? And he's walking through all of these heroes' journeys of the past. And what the author points out is he doesn't talk about what cryptocurrency is, what it does, how it performs as an investment. Instead, he tells a story about explorers and innovators in the shape of the hero's journey. And he says, non-ironically, that fortune favors the brave. So this answers the question, should I invest in blank? And you have to really apply a lot of critical thinking and almost detachment to say, am I investing in a story, or is there some fundamental function here for this investment? Because right now, stories are just getting decimated right now, whether it's electronic vehicle stocks. And you've heard us say this a lot before. Just because the future will be dramatically different in the future does not make a stock a worthy investment right now. There's electronic vehicles could change the world. That doesn't mean Rivian is going to be one of the survivors. It could be, it could not be, but that there's a fundamental story that has to be detached, fundamental, narrative that's to be detached from maybe the investment story.
Mhm.
So, Katie, what are some of the ways that he talks about insulating yourself from kind of that bait of the story when you're trying to invest, and how you can kind of respond to that?
Um, yeah, some of the things that he said. One, recognize that you're not immune. That you can be pulled into the story, as we all can be. So just really kind of recognizing that. But then he also says, when you're done with the story, pause for a minute, try to recognize how you're feeling or thinking about it. And then the next step, break it apart and say, okay, is that a realistic feeling? Is this a realistic story? Is it too good to be true? Or is it even, it can swing the other direction too. Is it so negative? Is the world really falling apart? And just kind of take that time to dissect what's actually being said before you put any action into
Yeah,
place. So kind of being very intentional about the pausing and the reflection.
yeah, yeah.
Yeah.
And he talks about thinking like a scientist, and
Yes.
that's something. We investing is not like physics. I mean, we're constant. Physics has laws, and actions have equal and opposite reactions. All those things. It is more like biology. There's a lot of inputs. There's a lot of observation. You have to challenge your beliefs sometimes and step back and say, we love this question. What could go right? What could go wrong? And have I ever been wrong? And that's a really good way of thinking about it, because there's plenty of upside, and people will always tell you about the upside of a particular investment option. But if something were to go wrong, does it impact your financial plan? Does it impact your security? What are the implications of that? And then that last humble question, have I ever been wrong about something before? And then you just say, okay, now should I be doing it?
Yeah.
Then the last piece this was interesting, thinking like a literary professor. So he talks about, good writers are also good readers and take in a lot of information and reading a lot of different sources. So, there's a lot of sound bites out there. So being careful to kind of diversify your sources and kind of go outside of that, read between the lines, so to speak.
Yeah. But something, he had a chart in there, and I'm not going to draw it like you, Dennis. I'm just going to use my hands, but it basically goes like this, like this, looking at the amount of information, the amount, like percentage of time that we take in information. And so I do think that it's important to really kind of diversify where you're gathering that information, but also sometimes just turn off the information for a while, take a break from the information flow, because it is very easy to kind of get caught up down that bunny trail and to have that confirmation bias of I'm thinking this way, and kind of starting to narrow and filling yourself, with something that validates how you're already thinking. But the amount of time spent on information, it was less than 10% in like 1900, and
Yeah.
now it's like
70.
70,
Yeah.
over 70% of
Or
our
waking hours.
our waking hours are consuming some sort of information and being fed advertisements, which are, designed to pull you in. Anyway.
We were even talking this morning. I listened to CNBC on the radio on my phone as I'm getting ready in the morning, and I have the commercial free segment. So during commercial breaks, they play snippets of other CNBC shows. And I think if you listen really closely to the language, this isn't to pick on CNBC. It's a media thing. If you listen very closely to the language, one of the hosts asked the guest, okay, all this volatility is happening in the market. How are you positioning your portfolio in the coming weeks? And it's like, weeks. If I presented you a financial plan that had the plan for the next couple of weeks, you could send me out on the next boat. That's not how we think about things. So just, I think it's important to kind of have those steep filters and put those at bay as you source out information. So and that ties back into everything from what we're trying to do here is help you to not just what to invest in, but how to think about investing. I think that's one of the most important skills that we can develop as investors is how do we think about our investment process and our investment philosophy and build high walls for things to get in. We should have very high walls. Those who didn't, again, are really feeling it right now.
Yes. And so that commercial that was, fast money, things moving fast. I think that's the other thing too, is if you put the good work into building a plan, an investment strategy that works, you have the luxury of being able to move slowly. Like if you're consistently moving slowly and consistently building, hopefully you don't feel the pressure to take action and to move fast when everything around you is moving fast. I think it's your opportunity to kind of pump the brakes and move slowly. I just think that's important to recognize too. And it's okay to bring down that amount of information that's being consumed at certain times if you just kind of need to decompress and take that time to reflect to say, okay, what does this actually mean for me?
Yeah. We're coming up on our time, so we really appreciate the feedback that we've received as we've kind of been preparing for these sessions. We're going to keep doing these, and just in the meantime, feel free to send us emails in the course of the week if there's a particular question you'd like us to do a deep dive on. But just to summarize some of the questions today and the things that we discussed. So are we in a bear market? We probably are in a lot of different asset classes. But remember that the unique thing about bear markets is it's not so much whether we're 20% down or 10% down or whatever it may be. Bear markets feel bad by nature. That's what a bear market is. It also feels bad at or near the bottom. We don't know when the bottom is going to occur, but we know it doesn't feel great. So just if we can work through that phase of it and be constructive and check in on our plan, we'll be good. What to do with short-term savings? Make sure you're looking at liquidity, you're looking at the quality and your guarantees, and making sure that you're not sacrificing the benefits of having that liquidity and that cash on hand. And then also make sure you have high walls. Be cautious of stories and projecting out short-term events. When things are moving so fast, be careful to project those out into the long term. Maintain your nimbleness, maintain kind of the ability to make good decisions along the way, and you'll be in good shape. So any closing thoughts, Katie?
Not really.
All right, so, sounds good.
I'm happy that, I'm happy that we received some questions. I'm happy that, it's an ongoing conversation, and I think it's really good. And I'm grateful that people joined us this morning, and I look forward to, checking in again next week. So.
All right. Sounds good. Have a great rest of the week, and we hope to catch up with all of you soon. Take care.
Take care.